is no ideal asset allocation ratio that suits all investors. So, what are the challenges does investor face in setting an asset allocation? How do they overcome them? How to protect your desired corpus from market volatility? To help you deal with these challenges, we have our investment expert Mr. Satish Prabhu with us. Satish, over to you.
So, how do you determine your asset allocation? And I will take this point by point. First is your risk appetite. So, to invest a very high amount of money in equity, you need to have a higher risk appetite. And when I say that, I mean a genuinely higher risk appetite. People have a higher risk appetite in equity when the markets go up. Their appetite for equity comes down suddenly when the markets go down. So that doesn't help. You need to have a genuinely high risk appetite if you want to invest higher amount of money in equities. But I can safely vouch that if you want higher wealth creation potential, you need to invest higher amounts in equity. And I will tell you the secret formula for that as to how you can do that. But if you want to create wealth, your allocation to equities has to be higher. Now, it's also about the run rate that you need. If you're trying to win a match, you have a run rate, right? If you have a lower run rate, then obviously you can take one run and over and still win the match. But if you have a higher run rate, at times you need to score more than 6 runs and over to win the match. So whenever you need to take more runs in an over, you need to take those higher risks. You need to hit those lofted shots for boundaries or for sixes to score higher and win the match. And how do you do that in investments? By investing in equities. If you want a higher run rate, you need to invest in equities to gather that run rate. And that is also one of the criterias for choosing asset allocation. The third criteria is your goal, and whether your goal is a short-term goal or your goal is a long-term goal. Now, if your goal is less than 5 years, please do not have equities as part of your asset allocation. If you have them with a lesser amount, or you have them as a hybrid between equity and debt, or you have a combination of various asset classes. But having a pure equity asset class for a goal which is less than 5 years is a strict no. The second point is that if your goal is, say your goal is to meet emergency funds, okay? Your goal is to meet emergency funds. Will you put that money in equities? You will not, because if you need money for emergencies and the same day the market has fallen by 10%, your money will be down by 10%. So there is no point in putting money which is to be used for emergencies in equities. That money has to be compulsorily put in a debt fund. That too perhaps in a liquid fund, so that the fluctuations are far lesser. Similarly, a goal, say, which is 3 years away. So I would say for a goal which is 3 years away, you should have a very, very less component of equity. I would say no component of equity is better, and put that money in a relatively in a debt fund. You know, for anything less than 5 years, putting larger sums of money in gold or debt could be detrimental. Smaller amounts may help, but larger amounts will not help. But if your goal is for more than 5 years, if your goal is a long-term goal of more than 5 years, you can invest money in equities. Because the secret which I was talking about of lesser fluctuation is that equities tend to have a lesser fluctuation or tend to be less volatile if you invest them over longer periods of time. That if I draw this line from 2002 to 2022, you will observe that the fluctuations over long periods of time are much lesser than the fluctuations over shorter periods of time. So it's very important that we invest in equities for longer periods and have a lower level of risk. So the secret formula is that to reduce the risk in equities, we are afraid of fluctuations, right? We feel that the markets fall and rise, and that gives us sleepless nights. But if you are a consistent investor, if you invest smaller amounts every month, and you are an investor who can stay invested for 10, 20, 30 years, that itself will give you lesser volatility in returns. Only that will give you lesser volatility in returns. If you look at markets for 1 year or 2 years or 3 years, for shorter periods, the volatility or the risk of returns is far, far higher. So the secret is to stay invested over longer periods of time. So I've told you about goals, that if you are investing for the long term, you put more money in equities. If you are investing for the short term, put very less money in equities. Now, last but not the least is the time to the goal. Now, what happens is that suppose you have a 10-year goal. You have saved money for your child's education, which is a 10 or a 15-year goal. As you near your goal and you put a lot of money in equities, there is a chance that that equity market can fall. And on the day you want that money, you will find that your entire portfolio is down by 50%. You don't want that to happen. So what you do is that you gradually move your corpus over the last few years, whether it's 3 years, whether it's 4 years, but gradually over the last few years, as you near your goal, slowly move that money to debt. That will help you keep your corpus safe as your goal nears. But if you have a goal that is far away, it is always prudent to put more money in equities. But remember that as you near your goal, equity being more volatile, it is prudent to move your money slowly into debt. And the day you withdraw your money, you will have all your money in debt, and the risk of volatility will be far lower. So those are the things that you need to have in mind while setting asset allocation.
Thanks for your detailed answer. If you have any doubt regarding this or any other financial or investment decision, don't hesitate to book an appointment with our financial expert. The link to the appointment is given in the description below. And also, would you like to know more about finance and investment? Then we would recommend you to attend our live webinar. The link to the webinar is also given in the description below. The webinar is absolutely free. If you like this video, hit like, and if you are new to our channel, please do subscribe.